Hi all, thank you so much for joining us. We'll just give it 1 or 2 more minutes whilst we wait for the rest of the attendees to join on, and then we'll kick off shortly. Being mindful of time, I think that we're going to kick off now. There's a couple of attendees to join, but I think let's get started. So hi all, and welcome to the first in a series of webinars created and curated specifically for you, our professional partners, through which we'll endeavor to bring you closer to all of our investment processes. Today's topic is the tech imperative, as you know, and we thought it specifically relevant as while many old world industries have struggled to survive during a period of crisis, many of these technology businesses have thrived. There are businesses that are inventing the future of the world, and we're exposed to them every single day through our commerce, communication, and leisure activities, and they truly define the navigation of change. The two presenters today and the guys that run our tech investment process are David Gibb and Henry Biddlecombe. David began analyzing the tech sector in 1988 in the midst of the dot-com bubble and went on to run the Stanlib Global Science and Technology Fund for several years. The peculiar market dynamic that played out over this period, with excessive valuations attributed to companies with little or no revenue, proved to be particularly valuable experience in how to differentiate companies with genuinely promising prospects and market hype. During the global financial crisis of 2008, David was the global internet and media analyst for Naspers. Reporting to the executive team, he had been tasked with seeking out strategic acquisitions in the tech space for the group at a time when asset valuations were depressed. This was a particularly formative period for David when he gained valuable insight into the science of identifying earlier stage businesses with high growth potential. Henry, after several years of corporate finance experience, Henry joined our anchor team and became a valuable contributor to the investment process in 2015 as an equities analyst. He contributed both to local and offshore investment processes, but his enthusiasm for researching the significance of technology-driven disruption for capital allocators has made him a natural fit for the anchor technology unit. And he's going to be kicking us off in a couple of seconds with the presentation. In terms of the day today, Henry's going to present. Thereafter, we'll have a number of questions for the panel, being Henry and David. So please feel free to send them through on the question and answer tab at the bottom of your screen, and then we'll wrap up at the end. Thank you so much for joining us this morning.
Right, Matt, it looks like my screen's coming through there. Don't you just want to confirm that?
Yes, Henry, we can see it.
Excellent. Okay, good morning, everyone. And thanks, Matt, for kind of stealing my thunder in the beginning. So I guess just to carry on from where Matt started, I guess there have been few times in human history where things have changed by so much and so quickly that it's turned the world almost entirely on its head. I mean, if you think about the way you communicate with friends, or you shop for things, or you conduct your business, or you transact, the impact has been huge. But the point to make is that the ramifications for the way we invest have been equally profound. If you were to select one trend that's kind of defined investing in the capital markets over the last 10 years, it's almost certainly been the proliferation of the global technology companies. And this is a trend that we think will remain in place for the next 10 years. And that's why we've called today's presentation the Tech Imperative, because we think it's imperative for you and your clients to be invested on the right side of this trend over the next 10 years. And I don't think there's any better illustration of the impact that it's had thus far than showing you how the list of the world's top 5 largest companies has evolved over time. So if you look at the top there, going back to 2004, it was dominated by big oil and finance, basically, which at the time made sense. But if you fast forward to today, it's almost the exclusive realm of the technology juggernauts. And that's no coincidence. It's for several reasons that we're going to touch on during the presentation today. And we'll explain why we think this will remain the case over the next decade again. But before we get started on that, you actually can't talk about investing in technology without discussing what we've all just been through as a society, right? As a society over the last 6 months, this pandemic. And I was on Twitter the other night, and I actually thought that this sort of fictitious survey question actually encapsulated it quite well. And they asked, who's led the digital transformation of your company? Has it been the CEO, the chief technology officer, or has it been the virus, actually? I thought that was quite funny because the true answer really is the virus, isn't it? The truth is, most companies have been forced into a level of technology adoption on a scale that would never have been the case without this pandemic. I mean, look at us today, meeting on Zoom. And I thought, well, actually, investors kind of find themselves in the same position, don't they? And you could rephrase this question in that vein. Who's led the digital transformation of your portfolio? And again, it's not your financial advisor or even your fund manager, it's been the virus. And you've certainly seen that in the way the S&P 500's played out year to date. And I want you to have a look at this table. So look at that first line there. The S&P 500 year to date is flat, okay? And that's kind of been the story that's been dominating news headlines up until now. And everyone's quite concerned about it because they can't tie up what's happening in the economy with what's happening in the market. But the truth is, if you look one level down, the makeup of that index today is entirely different than it was at the beginning of the year. So have a look at those top 2 sectors, the technology and communication sectors. They make up around 1/3 of the market. And they're up by between 15 and 20%. So there's a strong bull market there. But then have a look at the bottom of the chart, where you've got around 1/3 of the market, the traditional industries, which are still deeply in correction territory. So there's been massive rotation into tech. So although the market's flat, there are portions of the market that are still meaningfully down, and tech has rallied. And that's led to what I've come to term the Zoom effect. And I've called it the Zoom effect because I think the Zoom share price is a great illustration of what's happened. The light blue line is Zoom's return year to date, and the dark purple line is the S&P 500's return year to date. And you can see that there's a massive differential. Zoom's up 300% and the S&P 500's flat. And I think a lot of us are left feeling like the little guy standing in the books there, where we're either feeling like we've been left behind, or we kind of battling to grasp the valuations that we're seeing in the tech sector at this point. So it does feel uncomfortable buying technology shares at this point in time. But the truth is, there's actually no such thing as the Zoom effect. The truth is, this is merely a continuation of a secular trend that's been in place for the last 10 years. And what I've done to illustrate that is I've charted the relative performance of the NASDAQ versus the S&P 500 on this chart. And you can see that a NASDAQ investor over the last 10 years has enjoyed outperformance to the tune of around 127% over the last decade. And that is a life-changing number. So what am I trying to say? Well, I think now investors are left in a little bit of an awkward situation, aren't they? Because you've got short-term and long-term driving factors pulling in different directions in the tech sector. So short-term, you've got defensive rotation. In other words, people have bought tech companies because they're less impacted by the virus, which has pushed valuations to full or even uncomfortable levels. And I think there's also a genuine sort of fear of missing out factor there, where people are afraid they're going to miss out on the next Zoom. But we don't want those shorter term factors to distract you from the bigger picture and the more important longer term driving factors. And there are three of them that I want to touch on today. So the first is the massive research and development spend coming out of the tech space. Secondly, the frankly superior economics that technology firms demonstrate versus traditional industries. And thirdly, the relentless level and pace of innovation coming out of that sector, which is driving investor returns. But the point to make here is, in this sort of situation, the market's well suited to an actively managed strategy where managers can still go and find those good, strong secular growth stories, but while remaining cognizant of valuation, because certain shares have run away. So just to start on the first sort of driving force, the massive R&D spend, I want you to have a look at this table. And basically what I've done is I've just calculated what the top 5 largest technology companies in America have spent on research and development. So it's Alphabet, Amazon, Microsoft, Facebook, and Apple. Now look at the number in the bottom right-hand side of the table. The total is $900 billion over the last decade. That's almost $1 trillion that just these 5 companies have reinvested back into their businesses. And equally as astounding, they're earning an average return on invested capital of 20%. So in other words, these 5 companies are creating an additional $200 billion in shareholder value every year on the back of their research and development spend. I mean, to put that number in contrast, if you annualize that, that's around 1/3 of South Africa's GDP. That's a profound number. So it makes sense that these companies are benefiting from the future, right? Because they're spending on creating that future. The second driving force that I want to touch on are the superior economics of technology companies. And the best way to illustrate that is through a principle called network effects. And very simply, network effects are a phenomenon where as a company becomes larger, it becomes more valuable. So I'm going to use Amazon as a good example. Basically, as Amazon signs on more merchants and they sell more goods, so the platform becomes more appealing and more valuable to consumers like us. And in the same vein, the more consumers that make use of Amazon, the more valuable the platform becomes to vendors, isn't it? So through time, Amazon end up being able to earn more and more dollars per user. And at the same time, they're able to negotiate more lucrative deals with their suppliers. So in theory, that makes sense. But to really hit that point home, I want to show you a practical example of how this plays out from an investment perspective. So what I've done is I've charted the market value of 2 different companies going all the way back to 1996. So the first one, the blue line, is Procter & Gamble. So this is a share that a lot of your clients would have owned in their global portfolios over time, and it's a real bellwether blue chip stock. They pay around 70% of their earnings out as a dividend. They reinvest the other 30%, and they earn a return of around 10% on that reinvestment. So the rate of shareholder value creation is fairly linear over time, and you can see that on the way the chart progresses. By contrast, have a look at Amazon. Okay. Now, this is a very typical technology firm, which over the years has invested every single cent of its free cash flow back into growth, back into new ideas. And I want you to have a look at how, as the business has become bigger, so the rate of shareholder value creation has almost increased at an exponential rate. And to me, it's absolutely profound that now, as one of the world's biggest companies with a market capitalization of $1.4 trillion, it still has doubled in value in just the last 2 years. Now, this makes 2 points for me, and I want to emphasize them. The first is that when you're investing in technology companies and in the tech sector, you need to take a long-term view, because a lot of the value creation is back-end loaded. In other words, it only comes through in the later years, but when it comes through, it's powerful. You can see it on the chart. Secondly, when you invest in the tech sector, you need to stay the course. You mustn't trade in and out of it for exactly the same reason. The third driving force that I want to touch on is the relentless innovation coming out of this space. It's not just the top 5 technology companies that are innovating, obviously. There are hundreds of companies that are changing the way we do things every day in several different business categories for the better. And when we sat down to try and define our approach to investing in this space as a team, we thought that we should decide on which would be the important themes over the next 10 years. And I've listed some of them in this puzzle. I won't read all of them, but it's things like education, healthcare, e-commerce, and entertainment. And we came up with an investable universe, or a watch list of stocks that we'll use as a kind of a fishing pool for new investment ideas. And what struck me is that the collective value of these stocks that we're monitoring is $12 trillion. Now, to put that into context, the total value of the Johannesburg Stock Exchange today at the current exchange rate is around $400 billion. So our investment universe is around 30 times broader than the JSE. And that's something that I want you guys to think about when you're talking to your clients about what is an appropriate asset allocation framework. In other words, how much money should I take offshore and how much money should I invest in tech? But that's kind of enough about our broad approach. Now I just want to briefly touch on how we come up with individual investment ideas, because technology companies are different and the process of investing in a technology company is different. And a great way to illustrate this, and this is Dave's graph, not mine actually, it's called the market curve. And this is representative of the typical life cycle of a technology company. And there are 4 kind of phases to it. So in the beginning, when someone comes up with a new idea or a new business idea, generally speaking, a lot of hot, excited money chases that idea and it pushes valuations to almost uncomfortable levels. But then what happens is that those same investors start to look for evidence of revenue and profit growth. And often in that process, those valuations will come back down to reality. And it's at that point on this curve where we feel technology companies typically become attractive investments. So by way of example, I think Zoom right now is a great instance of a company where which is going through a pretty powerful hype cycle right now. So we're finding a little difficult to justify its current valuation. But moving forward along the curve, even now after this rally, we can still identify businesses that are attractively valued at the right point on this curve. Companies like Chegg, Spotify, and Facebook. And we'll touch on those in a little more detail further on in the presentation. And you can express the same principle along the sort of sales and profit life cycle of the company. So typically as a team, we won't invest in companies that are pre-revenue unless they're promising biotech companies, which are kind of pre-revenue by nature. But certainly we will invest in companies that aren't yet profitable or that are even loss-making. And my colleague, Peter Armitage, was the one that actually pointed out to me, the best time to buy Amazon was when it was losing money, was when it was losing $500 million back in 2000. Look how well you would have done if you'd invested then. And another great example of a business that we really like is Spotify. And it's a big position in our fund at around 7%. And that's a company that's only starting to break even now. So we're happy to own it, provided that there's a clear path to a meaning level of profitability. So that's enough on how we come up with sort of individual investment ideas. And I want to also touch on how we construct the portfolio of the fund. So if you look at the tech sector as a whole, it's a bit of a barbell, okay? In that on the one side, you've got big, mature, very large established technology businesses, which are generating billions of dollars in free cash flow. Companies like Google, Facebook, and Amazon. Now, these companies have 2 important qualities. The first is they have a lot of optionality, meaning that when a new competitor comes along, they can afford to compete with them or acquire them. And secondly, they're quite defensive. In other words, when there's an economic downturn, their balance sheets are so big and strong that they can simply weather the downturn. And we've seen that play out now. So these companies are good, safe bets. Even at this point in time, we don't think that they're overly expensive. And we still think that they'll generate a decent double-digit return. And typically, they'll constitute about 70% of our portfolio. But then we move on to the other side of the barbell. And that's where you've got what we call your emerging holdings. Now, these are the earlier stage businesses, which typically are demonstrating very high rates of revenue growth, but they aren't necessarily profitable yet. Some are even still loss-making. But these are the businesses which are going to generate the really high returns. So this is where a lot of the alpha of our portfolio will come from. And around 30% of our portfolio will be made up of those types of companies. And the point I really want to make to you today with this slide is that there are a lot of passive index tracking products out there which will tout their fees as a reason to invest, but they're not going to give you the exposure to this end of the market. And that's why we think an active strategy in the tech sector is a more appropriate solution, because we can take meaningful positions in those earlier stage companies that through time will deliver much higher returns. So I hope that gives you an idea of how we run our investment process and how we think about investing in technology companies. And the last section of my presentation is where I just touch on some of our favorite investment ideas. And I think it's the most fun as well. So let's talk about Spotify, right? I'm sure a lot of you use it. It's a great music streaming service. And it was started by a guy, Daniel Ek, who knew that you could never beat piracy. You had to come up with something better. And Spotify was the manifestation of that thought process. And it's become huge. People love it. They've got around 300 million users globally. It's growing at around 30% per annum. And interestingly, financially speaking, it's only starting to break even now. But we still think that the market isn't pricing the full value of the prospects of this business. And the reason we're excited about it is this graph. If I had to ask you, out of every dollar that the music industry generates, how much goes to the record label versus the artist and the streaming service? The answer certainly shocked me. It's 60 cents, which is really strange, right? Because in a day and an age when an artist can produce music in their own home and reach their listeners directly on their cell phones, what on earth do you need a record label for, especially when they take 60% of the revenue? So there's a huge incentive for the music artists and Spotify to work together to disintermediate the record label, because they can each grow their revenue by around 150% in doing so. And that's exactly what they're doing. And we don't necessarily think that a successful outcome there is reflected in the share price just yet. And it's also become an incredible technology platform. So I follow Post Malone on Spotify, for example, and he released the record a couple of months ago. And in just 3 days, he was able to accumulate 300,000 followers. Okay, now in traditional record industry lingo, that would have been a triple platinum record in 3 days. This was something that in the past just wasn't physically possible. Then at the same time, these guys are also starting to move into other areas of the value chain. So for example, as you like artists on their platform, you're able to buy tickets. So it'll tell you to their concerts. So it'll tell you when they're performing, where they're performing, and actually you can buy the tickets on the app. So you can see what they're doing. They're really aiming to dominate the full value chain of the music industry. So this is a company that I'm really excited about. And it's done well for us. We initiated the position at $140 last year. It was Dave's call. So all credit to him, Dave. And as they've signed some really interesting podcasting deals with Joe Rogan, Marvel Comics, and you would have seen last night in the news probably that they've just signed a deal with Michelle Obama. So the market started to recognize the potential of the business and they've started to price it in. So the stock's rallied hard all the way to $270. But interestingly, we still think that there's value in it. So that's a meaningful position in our fund. The next one is Chegg. So this was a really boring company at one stage, actually. They rented textbooks to students. But these guys took the same view of the college system in the US that we have. And that is, in its present form, it's just unsustainable. As a student, you're incurring hundreds of thousands of dollars in student debt to get a 4-year-long qualification, a fairly general one. And you're then entering a tight labor market where you're battling to get a job where you can afford to pay down the debt. So they've acquired a company called Thinkful, and they've approached it entirely differently. So they're saying, we're going to give you a course. It's 12 to 18 months in length, and it's going to cost you $30,000 to $50,000, but you only need to pay us when you get a job, and when you get a job which pays enough for you to repay us. So the model's obviously achieved a lot of early stage traction. They've got around 4 million subscribers at this point in time, and it's growing at 30% per annum. We initiated a position last year at $40. It treaded water for a while, but then they issued some really great guidance in the first quarter of this year, and the share popped, and it's now sitting at around $70. So it's done really well for us, but we think this is a great secular theme. So this is probably a share that we're going to continue to own. So those are representative of some of the ideas that we have in our fund. The other aspect that I wanted to touch on is NASPERS. And the reason is, I think South African investors have been really fortunate in that they've had exposure to the all-important tech theme over the last decade because we've had NASPERS on the JSE. But you now sit in a position where between 15 and 25% of their entire portfolio is in one single stock. And we don't think that's prudent, especially when there is a very viable alternative. And what perhaps they should think about doing at this point in time is diversifying their NASPERS holding into a fund like ours, where you retain exposure to that all-important technology theme, but without taking an unnecessarily high level of single company risk. Because there are a number of great technology businesses out there that are going to generate very similar levels of return. But we all know that putting your eggs in one basket is a bad idea. And we've seen what's played out on the JSE over the last 10 years. Bad things can happen and do happen. So just to talk a little bit about the performance of the fund since inception. The inception date was the 6th of June last year. Since then, we've returned 52% in rands, approximately. If you convert that into dollars, your return's been about 34%. So it's been around, you've had the benefit of around 18% in rand weakness. But we're very happy with the return to date. Okay, I can see some of my slides got a little mixed up here. The other thing I want to talk about are the fund objectives. So basically, what we're aiming to achieve is to meaningfully outperform global equity markets by taking relatively concentrated positions in high conviction ideas. The portfolio turnover, in other words, the number of times we buy and sell shares will be fairly low because the positions that we take are meant to be longer term positions. And typically we won't buy shares where the upside is less than about 50%. In terms of the team and process, Matt's already spoken to our experience, but we're led by David Gibb, who you'll meet in a second. Personally, I think David is the perfect guy to run the technology fund. He ran a tech fund in the midst of the dot-com bubble in 2000, so he understands the difference between a company which is overhyped and a company which has genuine prospects. He also worked in the corporate finance team at NASPERS, okay, which gave him some really sound experience in how to value earlier stage technology businesses, and he's supported by Solera and myself. The fund's currently 400 million rand in size, and it's available across most major platforms in South Africa. And if you'd like an availability matrix, we can send that to you. So just to conclude my presentation and to re-emphasize the three main points of what I'm trying to get across to you, we think that the tech sector will continue to outperform relative to the broader equity market. So an allocation there for your clients is really important. It's going to have a huge influence on their relative performance and their experience with you. The value creation in the tech space is back-end loaded. So you need to take a long-term view because often you'll realize 70 to 80% of the value of that investment in the last few years that you hold it. And for that same reason, you need to make the allocation and stay the course. Because these are higher valued shares, you need to expect that the volatility of that allocation will be higher than an allocation to the broader equity market. But over time, it would have been worthwhile to endure that volatility. So Matt, that kind of concludes the presentation. I guess you want to start with Q&A.
Thank you, Henry. Just to, I guess, before we move on to the Q&A section, and we've got a couple of nice questions for you guys to answer. I just want to ask you, Henry, obviously you've spoken to the technology fund being available in South Africa. How would, we've got a lot of our Mauritian partners on the call today. How would one access the portfolio as a non-South African investor?
So we're very happy, Matt, to run the same portfolio as a segregated mandate offshore in whatever structure is appropriate for that client. So we are absolutely capable of running a replication of this fund in a SEG portfolio in dollars offshore.
Okay, great. Thanks, Henry. Okay, a couple of questions here. Antitrust and regulatory measures, are they a big concern for big technology?
Yeah, so, okay, I'll take that one. I think you're reading a lot of that in the news at the moment, particularly around Facebook and Twitter, and how, for example, these platforms can be used to manipulate the US elections and how they can be used to spread misinformation. And in the same way that this is a problem, it's also a validation just of the reach and the power of these platforms. Okay, so think about it in both terms, but also these guys are working with the regulators to establish an appropriate framework on how to handle the situation going forward. So the point I'm making is, over time, it actually deepens the moat around these businesses, because there are very few companies in the world that have the ability to manage that complexity with an authority.
Thanks, Henry. So I'm just popping on to the next one. Any thoughts on the impact on tech from the poor China-US relations?
I'll run with that one. Yeah, I mean, the big issue there is the semiconductor space, where the US, they don't really want the Chinese to catch up, because the Chinese are behind in semiconductor technology. We have very limited exposure actually to the semiconductor space. I mean, our only investment is in a Dutch firm called ASML, and they make lithography equipment, which is used by customers all around the world. So I think what we need to be wary of, are companies that have big exposure to China and the US. I mean, Apple, for example, I think last year about 17% of their sales were to China, and a lot of their manufacturing happens in China. So we do need to be wary of firms that are exposed to both territories. TikTok is another example, and it's not listed. It's owned by a company called ByteDance, and you can see how the US might want to ban. Or certain companies don't want TikTok to be used by certain of their employees. So we just need to be wary of that space, because I don't think the conflict is going to go away. And Huawei is the other example, a telecom equipment business. Obviously, it's not listed. It's Chinese based. And there you would say, well, Nokia and Ericsson would be beneficiaries of this backlash against Huawei. So, there are companies, I guess, worth looking at. These problems will not go away. I don't think they would go away, even under a different administration in the US.
Thanks, Dave. Okay, I've got a question. What are some of the most exciting new areas in the tech sector?
Yeah, I mean, maybe I'll start with that, and Henry, you can
yeah, sure.
add later. I think one of the very exciting areas is quantum computing, which will replace the traditional computing that we are used to. I mean, our PCs at the moment run off a CPU, typically an Intel processor. And they've been reliant on Moore's law, where the number of transistors on the computer typically doubles every 18 months to 2 years. And you have a lot of money pouring into this sort of technology curve to try and keep up with Moore's law. And basically the feeling is that Moore's law eventually runs aground, and then we rely on quantum computing to take us forward. So we are a few years away from the commercialization of quantum computing, and there are a few players that seem to be leading in that field. IBM, Microsoft, and Google. So it's a few years off, probably another 5 years, and quantum computing will really sit in the cloud, because the computers have to operate at absolute zero. So we wouldn't be able to have that in our offices at home. But a very exciting field, and it will allow a level of computation, on very complex problems like climate change calculations. It will allow those to happen, which at the moment, it just can't happen. The computers are not powerful enough. There are a few other areas, obviously autonomous vehicles. We're at an early stage there. You'll recall maybe that Uber, they had a vehicle that was in an accident. It did have a co-driver in the car, and that seems to have set back autonomous vehicles for a while because people are now overly concerned about safety. But that will introduce the idea of massive fleets of autonomous vehicles, possibly owned by certain companies. Internet services it's a new area. It's really taken off in the last 2 years, particularly around things like online food delivery and other services that we can now do online. And they've really been accelerated by this COVID pandemic. So we have exposure to things like Delivery Hero and Meituan Dianping, which are also big online food delivery businesses, mostly in Asia. Henry, I don't know if you want to add any other areas.
Yeah, I mean, I guess one for me that I had to skip through in my presentation because my slides were jumbled up was just contextual commerce. I think what Facebook are doing with Shopify right now is really exciting. Just in that they're using Instagram to catch you in moments when your emotional propensity to spend is the highest. So traditionally you've had to go to a shopping center to spend your money. And for various reasons, if you might not be inclined to spend as much money as you would if you were sitting at home on your phone, immersed in photos of your favorite hobby or activity. So it's a really intelligent way of extracting the maximum amount of dollars per consumer on an e-commerce platform. So I think that's something to watch.
David, what are your top 5 books? That might be reference to some of the Mills and Boon books in the background that we can see. But outside of that, your top 5 books?
Well, there's a very good book. In fact, I read it. Sorry, I wasn't expecting this question, but a book called The Technology Trap by a chap called Carl Frey. And this is one of the concerns we have at the moment is what's happening with this shift to technology is a lot of jobs potentially are being eliminated. A similar thing happened in the Industrial Revolution, where the invention of the steam engine and a lot of jobs were destroyed. People working in the craft industries, and it took a while for society to adapt. You remember, stories about the Luddites who tried to destroy machinery that evolved because of the Industrial Revolution. And we are likely to go through a similar period now where will be a lot of resistance to the introduction of some new technologies. So Carl Frey's book is very good. I mean, I really enjoyed Satya Nadella's book on his book is called Hit Refresh on how he reinvented Microsoft. I mean, it's a phenomenal story. If you go back I think to about 2013, the share price was around $25 to $30, and now it's up at $200. There are plenty of other books, but those are just two good examples. The Technology Trap is a particularly interesting book.
Thanks, David. Okay, I've got a question. As someone just entering their 20s who would like to start investing, would it be better to start investing little bits every month or save up 1 or 2 years to put down a big principal? I'll take that if you guys don't mind, but you can jump in and give me your views on it. So, I mean, we obviously encounter this every day on the private client or wealth management side of the business. And the way that I like to think about investing is the way that I like to think about just about everything in life, and that it's a journey as opposed to just a kind of bandage that you yank off. And there's a lot of benefits to staying the course in a dutiful manner. I think the first thing that I'd say is that you know, your outcomes from an investment perspective are as reliant on your behavior as an investor as they are on getting the underlying investments correct. So don't, you know, dump money into the markets when they've run away from you. Don't pull money out of the markets when the markets have crashed. Would be kind of the one aspect of behavioral investment. But the other kind of big benefit is that through following a staid and considered approach over a long period of time to try and achieve long-term objectives, you're going to dollar average or smooth out your in prices and out prices on the things that you invest. Try and make small adjustments to strategy over time to take advantage of kind of long-term secular themes that you think will play out in your favor. A good example of this is the emergence of these technology type investment products or solutions. But certainly, you know, I think the fact that you're asking that question about investing in your 20s puts you a step ahead of, I'd say, 95% of the South African investment population. I'd probably say that that's the same for the rest of the world. People's attitudes towards investments tend to increase on a parabolic curve as they get closer and closer to retirement. And so, you know, the sooner that you can start the process, the better your outcomes are going to be through your career and especially towards kind of the back end of your career. If you guys want to add anything to that, if not, I'll jump into the next question, which is always a fan favorite, which is, what is your view on the currency? I assume the question relates to the South African rand dollar exchange rate and not the yen ruble exchange rate. So I'll kind of have a go there, but Dave, Henry, you can jump in and fill in the gaps that I might miss out on. So we've tracked as a diligence over time, and if you consume any of the stuff that we put out in the media or put out on our various websites and social media pages, we run a process which is headed by a guy called Nolan Vappenaar down in Cape Town, who runs our fixed income business, through which we've tracked the purchasing power parity or the inflationary differential between South Africa and specifically the US over a number of different time periods. And we put a lot of work and effort into identifying a good starting point for where we think it's reasonable to start tracking that line. What purchasing power parity is, I mean, I'm sure most of you guys know it, you're all accountants, so you're probably a bit smarter than I am. But ultimately, it's saying that if I earn 10 Rand or $10 a year as a salary here in South Africa, and my doppelganger in the US earns $10 a year today, and we have inflation of kind of 6%, and the US has inflation of 2% over time, and there's a differential of kind of roughly 4%. There's no reason why in 10 years time I should be earning 1.6 times what my doppelganger would be earning in dollars in the US. And the release valve is sorry, you'll see that my daughter's tracked me down eventually. I knew it would happen. I'm hiding upstairs, but she's found me. But the release valve is currency depreciation, and so to over time, the rand dollar tends to track that purchasing power parity line. Sometimes it overshoots and sometimes it pulls back, but over time it kind of tends to track it. In terms of where we see the fair value of the rand, we track 1 and 2 standard deviations out on a fair value chart that we send out from time to time. We would have the fair value of the rand significantly stronger than where it is today. So, it's always fun to put a number to it, because one day in a bar, hopefully we can be in a bar together one day. But one day someone in this crowd is going to come to me and say, it never got to that 15 Rand 50 that you said was fair value. But, we would be at roughly 15.50 to 16 Rand, fair value on the rand. And over time, kind of the walls of money that flow into emerging market assets when risks dissipate, we think that'll be help the rand be a beneficiary of that. If you guys want to jump in and add anything to that.
No, I think you covered that well.
Okay, I've got a question on experience to run a fund like this. You know, is it possible to kind of meaningfully run a fund like this out of South Africa? If you guys want to take that.
Right. I mean, I'll start with that. Look, I think, you know, we rely on conference calls. We can communicate with these companies probably just as much as anyone else out there. So it's a global village. It's very easy to have access to all the companies. You know, we're in earnings season now. Next week we start with 1 or 2 tech company results. Microsoft, the week after is a very big week. So we go through quarterly earnings every, you know, like everyone else would do. We've also been looking at this, you know, as Henry showed in one of those charts earlier, there can be a hype cycle in tech. So it helps to have a little bit of experience. You know, when I remember first started looking at Naspers in 1998, and they had an interest in a business called OpenTV, which they then listed on NASDAQ. And it was all about interactive TV, and you know, the share price went crazy. It went up over 100 Rand, and then it plummeted to 14 Rand just before the US invaded Iraq. You need to have some of these memories that come with you. I think tech in South Africa, I think we've had Naspers has been a great teacher for people like myself. You know, just learning from a guy like Koos Becker on how he approaches these things. So, look, I think we have experience, and Henry has worked directly in the tech sector. So he knows the hardware space particularly well. So, you know, when we talk about semiconductors, Henry he has a good understanding of things like the memory market. So I think it's important to have years under the belt and to see how value can be created and how value can be destroyed. Because some businesses will not, you know, the nature of network effects is typically one business will tend to establish a monopoly in a field. As we saw in social media in the early years, you know, MySpace, a company that was owned by News Corporation, they were the leader for a while in social media. And then Facebook arrived and it took over that field. MySpace eventually was pretty much worthless. It lost all its users. So you need to understand how network effects can develop quite quickly. And I think we have enough experience under the belt to take on a project like this.
Okay. With the international accounting standards placing more emphasis on the balance sheet over the last 30 odd years, and thereby creating opportunities for managers to manipulate the income statement through other comprehensive income, what steps can be taken to avoid exposing investors to the likes of Steinhoff, Wirecard, etc.?
So Matt, I mean, Dave, obviously you must answer this as well, but I guess typically it's really difficult to detect all instances of fraud because it's quite sophisticated. I think in the instance of Wirecard, if you read what that, and I forget her name now, that young short seller in New York wrote about Wirecard, you know, she was famously short of Wirecard. She says, you must always express a little bit of skepticism around unit economics that make sense. So go back to the first principles of the business and understand how they make money. And if the numbers don't make sense in that context, you know, then that's always a red flag. But also when we're investing in the tech sector, and Dave, I'm sure will say the same thing, we really focus on free cash flow as the important metric. And we use sort of long-term DCF models to determine the fair value of businesses. So we focused on the area which is more difficult to manipulate from an accounting point of view, and that is the free cash flow of the business. Dave, do you want to add to that?
Yeah, I think it's interesting. Balance sheets in a way are partly irrelevant for a lot of the tech companies. You know, they obviously invest in things like servers and some properties, but in some ways accounting needs to evolve to take account of things like network effects. so that you can use a balance sheet for a tech company and actually get something out of it. So, I mean, one of the things with a company like Naspers over the years was their balance sheet was quite small, and they would expense everything through the income statement. So whether you looked at the income statement or the balance sheet, it was difficult to establish value, which is very unlike a bank where, you know, you look at the book value of the bank and you look at the return on the book value to establish a potential price to tangible book value. So I think in tech, in some ways, the accounts don't help that much. And, you know, there's been a lot written on this, and I think it will need to evolve, you know, with the top 5 tech companies now representing around 24% of the S&P 500. You know, if you're completely reliant only on their financial statements to establish value, it becomes difficult. You know, you need to know a lot more about their market to establish value, as opposed to just relying on the income statement and the balance sheet. So I think tech is a slightly different case, where financial statements, I think the changes need to be made to be able to recognize these sort of intangible values.
I see there's a guy named Ruan who wants to know why we don't own Tesla. You and me both, Ruan. No, I mean, that's actually not his question. So Dave, he's asked, does the fund have any exposure to companies like Tesla or renewable energies, even though they may fall in other industries such as automotive and energy, etc.? That's one for you, I think.
Yeah, that's a good question. We do have some exposure to Tesla. It's through Scottish investments, Scottish Mortgage Investment Trust. I mean, we put a little stake in that when we launched the fund, and its biggest holding isn't Tesla. We've missed Tesla, so we've missed that one for now. But our direct exposure to Tesla is probably around, it will be just less than 1% of the fund. But that's an oversight. You know, it's a big category out there, so we've tried to focus on our areas of strength, and then we're gradually adding new categories. So, for example, I mean, in the last month or so, I've been looking a lot at the hydrogen sector, and you know, this would be a new area of energy source, particularly to power things like buses and trucks, and it's a way of helping us reduce our carbon emissions. One of the problems in the renewable space is that prices tend to come down so much every year. And so it's been hard to find an area to invest in. I mean, I've looked at German companies like SMA Solar in the past. You know, if you look at some of the solar panel manufacturers, you know, the deflation is just so strong that the share prices actually don't perform very well. But in the hydrogen space, look, there's been a big pop in those shares in the last little while. But it's early days there. So, you know, there are companies like Ballard, PowerCell, which is a Swedish company. So those are companies we are keeping an eye on. I'm very interested in that renewable energy area. So it's just difficult to find one that is not impacted too much by deflation. But for now, the fuel cell area is interesting for me, particularly in the hydrogen space.
Guys, I think we're going to, just being mindful of time, I think we're going to take our last question unless someone else sneaks one in. And it's, how will blockchain affect the finance function going forward? And then we'll wrap.
Well,
so I know Dave's got a, yeah. You go ahead, Dave.
I don't have a, blockchain is being, you know, a lot of companies are experimenting with blockchain. Big banks like JP Morgan. I think blockchain will introduce a lot of efficiencies in the back-end processes of companies. And, you know, a lot of things take days to clear. even if you're in freight forwarding. So, for example, a big shipping business like Maersk, the Danish shipping company, they are also working with IBM on blockchain technologies. Just, you know, a lot of the paperwork that happens on import and export is just enormous amounts of paperwork. I know IBM has been working a little bit with Walmart on blockchain in food sourcing, so you know exactly that these avocados are coming from Mexico, so you can track and trace any outbreaks of infections, for example, like E. coli infections. So I think it's just going to introduce a lot of efficiency. Frankly, news has gone a little bit quiet on blockchain. So there was a lot of hype, probably, 18 months ago, Henry, I would say. But now I think a lot of companies are experimenting with it. And I would see it as a cost reduction mechanism, and, you know, and certainly make business a lot more efficient, particularly in areas like finance and trade.
Thanks, guys. All right, three minutes to 9. I think we'll wrap up here. I want to thank everyone for having joined us today. Thanks. I know that everyone's very busy, and we really appreciate getting to spend a bit of time with you. If you have any further questions on any of the holdings inside of the fund, you know, we'd be delighted to share them with you. And any other questions, obviously Henry, David, myself, and any of the team of the Anchor Capital guys that service you or communicate with you, I'm sure would be delighted to spend a bit more time around it. Before we wrap, guys, you haven't chatted too much to performance of the fund relative to kind of benchmarks. How have you guys done?
So we've performed in line with our benchmark in this first year. We've picked a very tough benchmark, which has Apple and Microsoft. They make up about 36% of our benchmark, and Apple was up over 80% over the last year in dollars. So we have managed to keep up with that index for now. So it's coincided with a particularly strong year in tech, particularly in software businesses like Microsoft. So I think we've done well. We are running at about an 82% equity content at the moment. We've got some cash. We've had a lot of inflows, particularly in the month of May. We took in 100 million of inflows. So it's been a busy period for us. So I think we've done well in our first year. We've had a few companies that have gone up about 3 times. One of them is Delivery Hero. So we've caught some areas very nicely on things like online food delivery. So I think a good start for us, and our fund is well established, and we've been off to a good first year of performance.
Great, guys. Well, thank you so much, and thanks everyone for joining us. And we're looking forward to hosting you at a number more of these. If you have specific areas of interest or specific topics that you'd like us to cover in the future, please share them with us, and we'll be sure to deliver that to you via this channel in the future. Thanks very much, guys.
Thank you.